Welcome to this new episode. Today we go straight to the heart of a topic that is setting the markets ablaze: gold. The yellow metal has captivated headlines and investors with an impressive run, but behind the glittering numbers lie complex dynamics, strategic maneuvers, and technical signals that deserve attention. So get ready. Today we explore what's really happening with gold, why China sold off massively, and whether we are truly near a trend reversal or just at the beginning of something much bigger. Let's start with the raw data. Since the beginning of the year, gold has gained 29.1%, hitting record highs and attracting capital as a safe haven in a context dominated by political instability, trade wars, monetary concerns, and geopolitical tensions. However, not everything is linear. Let's take a step back. On April 2nd, amidst the rally, a sudden correction occurred. A drop of over 6%, greater than 6%, in a few days, caused by a wave of liquidations and a rush to liquidity by investors. It's a classic mechanism in moments of panic, reminiscent of 2008, when de-risking occurs. No asset class is safe, not even gold. But the precious metal quickly recovered, fueled by a combination of global uncertainties and dollar weakness. The question is this movement sustainable? Or has it become excessive? To answer this, let's delve into the world of futures on COMEX and Asian exchanges, analyzing three fundamental technical indicators provided by Option Metrics: implied volatility, the skew of out-of-the-money options, and the shape of the futures curve. Let's start with implied volatility. Gold is known for its relative stability, with a historical average 30-day volatility of 16.8% since 2005. Yet today, this volatility has increased by about 10 percentage points compared to the end of March. This is not yet an alarming level, but it signals increased uncertainty and price movements. However, historically, we are not yet in an extreme zone. Second indicator: the skew between out-of-the-money and in-the-money options. On average, since 2005, the skew between options with a delta of 0.50, 0.50, and 0.25 has been 0.50, 0.50 percentage points. Currently, we are between 1.30, 1.30, and 1.50, 1.50, a high level, but not exceptional. This type of skew can be interpreted as a contrarian sentiment indicator. The more retail investors buy out of the money options, the more emotionally exposed they become, and the greater the risk that the market will prove them wrong. Third and final indicator: the shape of the gold futures curve. Gold tends to trade in contango, meaning future prices are higher than the spot price, as it is a storable commodity. When the curve steepens significantly, it signals long-term optimism. However, since the beginning of 2022, the curve has indeed steepened, but without sudden surges. From January 1st to April 21st of this year, the spread between 30-day and 182-day contracts widened moderately, but nothing suggesting a bubble. Now let's move to Asia. On April 30th, according to a Goldman Sachs report, China suddenly liquidated about 1 million ounces of gold between the SHFE and SGE, the two main Chinese exchanges. Just a week earlier, on April 22nd, it had purchased about 1.2 million ounces, pushing the price of gold to new record highs. But why this sudden reversal? The answer lies in two factors: the May 1st holiday and the lack of hedging instruments during the holidays. In a market that remains closed for 4 days, no rational trader in China wants to remain exposed to a position they cannot hedge. The sale is therefore a technical choice, not necessarily a change in outlook. However, the concern is the domino effect. The Chinese selling occurs during Asian hours, which are notoriously less liquid, and this triggers automatic sell signals from CTAs, commodity trading advisors, in Europe and the United States. This creates an amplified effect. A relatively contained sale can generate a disproportionate reaction in global markets. And there's more. The average entry price for gold ETFs this year has been around $3,010 per ounce. However, between $3,175, $3,175, and $3,450, another $4.7 billion worth of gold was bought by ETFs. If the price were to fall below these levels, many of these investors would risk losses, triggering further outflows that would worsen the bearish trend. And the technical levels are well known to professionals. If gold were to close below the 21-day moving average, around $3,200, it could fall towards the technical support at $3,110, in line with the 50-day average. Here too, other key levels for CTAs are $3,300, $3,300, and $3,175. No less important is the dollar effect. As long as the greenback remains weak, gold benefits. But any sign of dollar strength can cause an immediate downturn in gold. The chart relating gold to the DXY index clearly demonstrates this. Finally, a curiosity. The gap between gold and Bitcoin has practically disappeared. This signals that, in a hyper-volatile context lacking fixed points, both safe haven assets are moving with increasingly similar dynamics, attracting the same type of investors. In summary? No, gold is not yet technically overloaded or overbought. The data on volatility, skew, and the futures curve indicate a still orderly market. But beware. It takes little to change everything. The next few days will be decisive. If stocks, bonds, and currencies manage to regain some stability, it will be interesting to see if the new gold buyers remain loyal or abandon ship.